I'm going to cover a few big themes here going forward: the labor market, the housing market, and fiscal policy. And I'm going to do so with a focus on British Columbia specifically. And I do understand that those are very big topics, and 10 or 15 minutes probably is not enough to do them justice. But we'll do what we can, and of course we do have some Q&A to follow as well, where we can circle back on some of these things. So first of all, if you look across the Canadian landscape, and Doug laid out the national forecast, when you drill below the surface, one thing we usually caution is that the headline Canadian numbers typically do mask a lot of variation across the different regions of Canada. So some are strong when oil prices are strong. Others, like Ontario, Quebec, British Columbia, pre-COVID, were driving economic growth. What's unique about this situation now is that like the global economy more broadly, pretty well every province in Canada suffered a very extreme shock last year. Every other province in Canada is experiencing a very strong rebound now and into 2022. So you can see the growth numbers there, and they do vary a little bit by region, but effectively, to some degree, all provinces in Canada have dealt with a significant hit and are in recovery mode now. British Columbia stands out positively, I would say, here. First of all, the decline last year was a little bit shallower than the rest of Canada overall, especially the bigger two provinces in Ontario and Quebec. But the recovery now is looking quite a bit stronger as well. And I would say part of that is the result of better healthcare outcomes in BC. The pandemic curve was never as steep as some of the other provinces, and as a result of that, we never saw the aggressiveness in terms of lockdown measures that we saw in areas like, say, Toronto or in Montreal. So that helped last year. And then this year we're seeing momentum, not only as the economy picks up as some of these restrictions do come off, but the resource price backdrop has been very friendly. Lumber prices, base metal prices, which you don't tend to hear too much about, are actually supporting economic growth in BC quite a bit. We tend to focus on what real GDP is doing, or real economic output. When you consider what's happening in a lot of these resource sectors, the value in dollar terms of economic output is going to look even stronger than these real growth numbers would suggest. So from British Columbia's perspective, that's quite strong. And of course, the housing market has come back extremely fast, which I'll touch on in a few minutes. And then, at the end of the day, as we do settle back into some kind of semblance of normalcy post-pandemic, we do continue to believe, and this was the case pre-COVID as well, that British Columbia just has a faster run rate than some of the other provinces like Ontario and Quebec. So we do think the province continues to lead. And from that perspective, I think it's still a very good news story in BC. With respect to what's happened in the labor market, now, obviously, we did see a pretty significant shock in the province from a historical perspective, be it the jobless rate or the hit to employment. But on a relative basis, British Columbia has held up actually quite well. And if you look at where we are today, Canada-wide, we're still looking at employment that's about 4.5% below pre-COVID levels. In British Columbia, we're only down about 1.5%. And I say only carefully because that's still a pretty significant shock. But if you consider the size of the hole that some of the others like Quebec and Ontario still have to dig out of, British Columbia starts to actually look quite good. And in fact, if you look across a wider range of industries and compare them to pre-COVID levels, things like home sales, retail sales, manufacturing, wholesale activity, British Columbia across most of the spectrum has already recovered. So the other takeaway here is when we focus a lot on growth, but the reality is that the level of economic output in British Columbia is running quite a bit stronger now versus pre-COVID levels than anywhere else in Canada. So that's certainly just kind of highlights the fact that BC has come through this relatively well, and we are still optimistic. Drilling a little bit further into the labor market, one thing we see is that there are still obviously some sectors that have been hit quite a bit harder than others. So this chart is kind of telling in that if you plot the various sectors and where they are on an employment basis versus last February, what you're looking at here is as you move left to right on this chart, you're moving basically from weak to strong in terms of employment growth versus last February. If you go from the bottom to the top on this chart, you're moving up the wage scale. So pretty clearly you can see where at the industry level, the employment impact is still lingering. It's in obvious areas like accommodation and food, industries related to travel, industries related to very close face-to-face type of services. In some cases, those industries are still down 15 to 30% across Canada from pre-COVID levels. But if you look over to the right of that vertical bar, those are industries that are not only back to where they were pre-COVID, but they've actually seen employment rise above those levels. Areas like finance, professional services, industries that are much higher on the pay scale have held up quite a bit better. So when we look at, say, a Vancouver, for example, yes, we've seen this very fragmented labor market where, because it's a big urban center, the restaurants and the retail type of employment have been really held back. But the flip side is that a lot of the other sectors that are predominant in a big market like Vancouver, like the finance and the tech, they've come back actually very well. So that's probably the next phase of this recovery as we reach something that looks more like herd immunity, and as we get into 2022, when these restrictions can come off more significantly, that's when we're going to start to see those sectors on the left side of this chart start to make some ground back, and there is a lot of ground still to be made up there. But the other takeaway from this is that, and as we shift over to the story on the housing market, that the highest paying sectors in Canada have not only recovered, but they've seen employment rise above where they were pre-COVID. So one of the questions when we look at the housing market here is how did this market fare so well and come out so strong considering the shock that we've seen to the labor market? And one of the answers is that, well, the area of the labor market where the vast majority of home buyers would be, as opposed to renters lower down the wage scale, has actually held in very well and come back very quickly. So from that perspective, the income side of the demand curve has held up very well. Layer onto that, a very, very aggressive transfers from the federal government down to the household level. This is a very unique recession in that we've actually seen household disposable income rise, which historically we have never seen. And to be sure, some of that is finding its way into housing activity as well. You throw on top of that record low mortgage rates, so 5-year fixed rates right now are running in the 1.5 to 1.7% range. Probably have seen the lows on those for this cycle as longer term bond yields have backed up, and we've started to see some movement on the mortgage rate front. But for sure that has helped stimulate the demand curve as well. And then really the big factor here has been this shift in preferences away from the core of the big cities to single detached homes, to homes with more space, and to homes a little bit further outside the core. And just given that this whole shift to work from home for a lot of individuals in various sectors of the economy has opened up this affordability valve, so to speak, where rather than being tied within like an hour commuting distance of a major urban center like a Vancouver, we now have kind of this little bit more freedom to push out 1 to 2 hours away from the city. And that's really where the strongest markets in Canada are right now. And in BC specifically, Fraser Valley and the Okanagan are off the charts strong, with gains versus a year ago upwards of 25 to 30% in some of those submarkets. And yes, there's a bit of a uptake of recreational property there too as well, just given that incomes are up and people just really don't have anywhere to go. There's nowhere to travel, and spending on services is constrained. So we've seen extremely heated demand for this type of real estate. So where we go from here is the real question. Part of this shift, I would say, is permanent. So we've been actually, bullish or defenders of the Canadian housing market for a long time, and especially the single detached market, because there is a pretty big demographic force at play, being the baby boom echo or the millennials. And I do think that this migration out of the major cities was a trend that was waiting to happen anyway. In fact, year after year, you tend to see this outward migration from the bigger cities to some of the perimeter parts of the provinces. That happens to have accelerated pretty dramatically during COVID. But I think what you do see here is that the pandemic, it pulled forward a lot of this shift in relative demand into a very short window that was going to happen over a gradual period of time anyway. So I think some of it is here to stay, and we're probably not going to go back to pre-COVID pricing on single detached homes in some of these smaller perimeter markets. But I do think that, we're running at 20 or 30% year over year, and this is not sustainable. And I kind of get the sense that there's a little bit of speculative activity starting to come into the market here as well. So I can very well see as mortgage rates do back up, and as the pandemic kind of winds down and the rush to vacation properties and the rush out of the cities subsides, we do give back some of the gains we've seen in prices in some of these markets. Maybe it looks like what we saw back in 2016, 2017, after some froth came out of the Vancouver and the Toronto markets during that period. But a complete reset to valuations or to price levels that we saw before COVID is probably not going to happen either. I don't think we're going all the way back. The other aspect of this, and I know we don't have time to go into all the weeds here, but the condo market has been quite a bit more stagnant in the major cities in Canada, and Vancouver included, simply because the economics there have changed. For one, I mean, the movement has been away from the city for now, which I do think is probably temporary longer term. But for now, we are seeing flows away from the city. And because of that, we've seen vacancies pick up and we've seen rents kind of depressed. And as a result of that, from an investment perspective, the economics have changed a little bit on the condo side. The short-term rental market, for example, which was filling in a lot of the cash flow that the condo market, from a long-term rent perspective, couldn't carry pre-COVID. Well, that market is kind of dried up right now. So we've actually seen condo prices more or less hold flat. Some of the smaller units have corrected a little bit, but by and large, that's a market that's been pretty soft right now. Is it going to come back? I think we're going to probably, over the course of 2022, start to find a footing in some of those areas as the cities come back to life, and I do think they will. So from a fiscal perspective, I'll change gears a little bit here. And take a quick look at what government finances are doing right now. So this is just to start off at the provincial level. This is a quick chart to kind of lay out how the provinces rank from a fiscal perspective. This is the fiscal year that's just winding down now. And so what you can do here on this chart is, if you look up the vertical axis, that's the deficit growing as you go up as a share of GDP, and as you go out across the horizontal axis, that's net debt as a share of GDP, again growing as you go out. So where you want to be on this chart is down in the bottom left corner, ideally. British Columbia is the last remaining AAA credit, possibly a credit, if we're being frank here, that might be at risk, just given that British Columbia has very quickly moved up from right down in the bottom left corner of this chart up and to the right. So from that perspective, we have seen government finances deteriorate a little bit in the province, for sure. On a relative basis, though, I mean, look at where British Columbia is versus the group. We're still in a very, very favorable situation. I think that deficit is going to come down pretty quickly as the economy recovers and some of the temporary support measures roll off. I think we probably already have seen peak deficits in the provinces. From a debt perspective, British Columbia, especially compared to its bigger peers in Quebec and Ontario, still magnitudes lower on a debt perspective and on a borrowing perspective. So BC does still come to financial markets and borrow for less than Ontario and Quebec, even though we have seen the province backslide a little bit on some of these fiscal metrics. And probably the more important thing here, though, is when you consider the provincial fiscal picture, I mean, yes, all provinces on this chart have moved up and to the right over the past year. But Ottawa and the federal government have done the vast majority of the lifting, and they've provided the vast majority of the support, and really taken a lot of the burden off what could have been down at the provincial level. So $275 billion of direct spending support from Ottawa has flowed through programs like the CERB and the wage subsidy. that was more or less designed to just get money out fast and in bulk in order to keep households and businesses liquid and solvent through this downturn. So when policymakers come back and say, okay, from a healthcare perspective, it's okay now to start opening back up and go back to your everyday lives kind of thing, that there are actually still businesses there to come back and turn the lights on. So that's what fiscal policy to date has done. Potentially there's more stimulus coming, and we'll see what kind of form that takes. But I would say that the size of this deficit, like as you look at this chart here, you say, wow, that's 380 billion. That's extremely big. Canada is going to be in some tough shape here. And I would say, yes, there's going to be some work to do, but there are a few factors that kind of ease the concern a little bit. One is that, you got to keep in mind that everybody has more or less been in this same boat together. Canada has, yes, they've offered up more stimulus than most other countries, and they've seen the relative deterioration in their budget balance a little bit more significant than a lot of other countries. But Canada came into this in a much more favorable position as well, especially from a net debt perspective. So they did have capacity to stimulate the economy coming into this. The other factor here is that if you look at what it's costing Ottawa to service these deficits and to borrow right now, it's actually very favorable. Because of the low interest rate environment that we're in. So just as an example, Ottawa right now spends about 7 or 8 cents on every dollar of revenue servicing debt. If you go back to the 1990s when we had a real fiscal situation in Canada, Ottawa was spending about 35 cents on every dollar to service the debt. So from that perspective, we do have some, some wiggle room. And the other thing is, look how quickly that deficit can potentially come down in the years ahead, just by not doing anything over the next year or two. That deficit's going to consolidate a lot. So by not extending a lot of these massive support programs, by potentially not spending all of that $100 billion of possible new stimulus over the next 3 years, and by letting the economy rebound in what should be very strong fashion based on the forecast we've already kind of discussed, that should bring revenues back pretty quickly. So just by taking their hands off and letting things evolve, we could very quickly be looking at a deficit that's more around 5, 6 or mid-single digits as a percent of GDP, and very quickly it becomes something that looks a little bit more reasonable. And then obviously from there might be some more work to do to bring the rest of that into balance. But I do think that there is potential for some pretty good fiscal consolidation ahead. So then just to wrap it up, before we switch to some Q&A, a few just final thoughts on British Columbia. And it's pretty clear that we're optimistic and we're positive on the province. I think just the course that it has navigated through the pandemic has been the biggest one. The real estate is obviously on fire again across most of the province, but areas like technology and professional services are really where we're seeing employment growth being driven right now, as well as the resource sector, which has been one of the really big surprises coming out of this. We did not expect those sectors to come back as quickly as they have. On the challenges, the one thing I would say is that travel and tourism, yes, we're kind of gearing up for an environment where we could see travel flows returning. It might take a little bit longer to get there. Realistically, maybe it's a 2022 story, but I do think there's going to be pretty tremendous pent-up demand for things like travel and tourism as we kind of take the shackles of the pandemic off, so to speak. Affordability is always an issue, and then I would say that the fiscal situation is on a relative basis is one that's still quite positive, but it's probably an area that's worth keeping an eye on, just given some of the priorities shifting around at the provincial level from a financial perspective.